Well, hello everybody. It's January 17th, the weekly review, where we try to take a look at what happened and look at what we should expect. We're going to stay with that same format we started last week. Try to do it short and sweet, but comprehensive. Big down week. Again, 3%, 2%, down huge amounts to start the year. There's just no relief in the way this thing is selling, and Friday we had more escalation to the downside. So if we go to the details here, is there anything technically that tells us this is done? And unfortunately, I don't think there is. If I pull up the S&P 500, for example, we have a push down, a little bit of a stagnation there this past week, the first 4 days, and then escalation back to the downside on Friday. That escalation took form in a higher volume push to the downside, and then a bounce back, so it gets under back over but more volume. Under back over more volume really doesn't help, because it says that can come right back down here and test it again. And so if I'm looking here on this time frame, it doesn't tell me anything with respect to this is done. Now there are some mixed signals, and we'll get to those. But on a short-term time frame, whether you're looking at the S&P 500, you're looking at the NASDAQ, which also under back over but heavier volume, or you go to the Russell, which actually outperformed on Friday, under back over as well. So short-term, yes, it could turn, but no, there's no strong signals saying that in fact we are going to turn here. These signals tell us that we could test those lows again come Monday. Well, actually we're off Monday, but Tuesday. Another thing we've talked about before that continues to be a sore thumb is this Dow theory and the transports and how they have been sold down. They've been a leading sector to the downside. Even if you don't believe in the Dow theory, it's hard to construe what you see here as bullish. If I pull up the IYT and look at it, here's the monthly. You can see the top was made back in November of 2014. So after we had a decent sell-off, you spike it back up, and then it's been nothing but down since then. So a year and a half now of down, and this thing is making new lows. It's already broken once. It's trying to break again. There's nothing bullish about the way this looks. Indexes and sectors. If you take a look at these, indexes, sectors that we brought up last week, the selling this week simply made it worse. IYT is one of them. It's bearish already. I'm talking about the long-term time frame. It's sideways now and bearish this month if it closes where it is. To get back to where it needs to go, and if I pull that chart back up, to get back where it needs to go, it's got to get back over this particular swing point low. If it can't, right, then it's going to break. And I'm talking about this one, right? So you got to get back over this price point. You can see it's under it. It's under it by the count of about 4%, almost 5%. The weekly ATR is about 5.5%. We have 2 weeks left in the month. So clearly, we're going to have to see this thing improve, because if it doesn't improve, probably this week, then we're going to be in danger of actually going bearish on that time frame. XLF, this actually should say XLI. I'm sorry, I've got a mistake there. I'll make that change for you. But you can see they're underneath now. So if I pull those up, here's the XLF. And let me put it on the monthly. So pull the monthly up here. You can see it's coming after that swing point low. And the XLI has the same situation. And finally, the Russell itself is also underneath. And so we have major sectors and one of the major indexes, right, where it's breaking underneath. And if it doesn't get back over, we're going to end up with the trend transition. Again, these trends don't change very often. I mean, you can see the last time this changed was way down here. That was August of 2011. If we change up here, right, Doesn't necessarily mean we're going down again, because you can see here we actually went up afterwards. But it's another sign, right, that we've got some serious deterioration. Unlike this period back here, where you got a huge fast move down, you've had a consolidation now for a year and a half. And so my feeling, and what I've tried to express, is that this is a different story than we had back here. And if we do start to break down here, it's a result of slow deterioration across many stocks and sectors, and now the indexes. So it doesn't mean it's going to happen. It's only 3% underneath. It moves about 4.5%, almost 5% per week. So there's plenty of time for this to actually pop back up. But again, 2 weeks left. If it goes down much more, it's going to be much more difficult for this to actually get a save. The other big thing is that if you look at the index sectors, right, the sectors themselves, the bulk of those with the heavy weighting are not showing us they're going to turn, or at least so far they're not showing it. And what I'm talking about are these that are highlighted: XLF, XLI, XLK, and the XLP. If you take the weighting, right, you're more than 50% of the index, and there's no turn showing on these yet. And just to show you, here's the move down. I mean, we could actually, suggest an ABCD structure here that's just trying to complete, which means we have farther to go. This is on the XLF on the daily. If we go to the weekly, we've got the same sort of a structure. It's already completed here, but we're underneath these lows. There's just nothing here yet. We've got volume escalation. We don't have anything to show us yet that this is turning. And as we already looked at, this is underneath that swing point low, and it needs to recover. And you got an ABCD structure here as well, potentially that could set up. Well, actually, this one has that long bar tail to the bottom, so I don't think it's going to ABC, but there's just nothing in any of the time frames on any of these sectors, which is over half the weighting, to show us that they're going to turn. Now, we do have that elsewhere, right? 2-bar reversals. We've got a turn already on the XLE. You've got an over-under and another 2-bar down here. So there is some signs of turn elsewhere, but the bulk of it is just not there yet. Do realize that can happen soon, but so far it hasn't. The big culprit this last week was the crude oil. We had a continued build-up in inventories and price downturn. That price spread, the credit spread here, you can see I'm using FRED, which is the spread between treasuries and high-yield debt. You can see here that this has had a significant move back to the upside here. It's not over these levels that we saw that were critical before, and certainly nothing like what we saw in 2008. But that spread is going up, right? The direction is this way. It's not down. And that is the pressure that this market's feeling. And what I mean by that is the market is trying to price in failures, bank defaults, failures, primarily in the industry, the energy industry, but in related fields as well, as a result of the squeezes that are taking place there, as these companies are losing the battle to keep their head above water. And finally, we ask ourselves, what's the best thing this market's got going for it? It's just that it's so negative. It's so stretched in such a short period of time. It's going to get a big bounce here, just like we saw last week on that big push back up on Thursday, right, where this thing skyrocketed back up, right, 2.5%, had a 3% drop the day before. And then, of course, we plummeted down again. That was on earnings in particular, and then again on oil Friday morning. But, this stretch, the numbers. The stretch here has been extreme. There hasn't been any pause so far. And when you don't get pause and you continue to stretch, right, you're going to get a huge bounce off of that at some point. Doesn't say it's here. There's nothing to tell us yet. But you just know that possibility is there, and that's probably the biggest positive that the market has going for it. And you can see that in other measures too. For example, if I bring up the bearish index projections, many of these have already hit. For example, if I look at the NASDAQ or the NDX on a short-term time frame, they're almost done. And what we're looking at here is if we pull it up and draw them in, you've got an ABCD structure, starts here, goes up, right, back down, and it's almost done. There's not much left. The NDX looks the same way. If we come back over, you've got the same sort of thing in the Russell. In other words, on the monthly time frame, the Russell, and on the weekly, the Russell is more than done. That's how stretched that one is, and they've been killed. Same thing on the CACs. And the DAX on the weekly time frame, here on the Hong Kong and the Nikkei markets as well. So we've already overshot in a big way some of these, and in a reasonable way some of the others, and that's happened on a weekly time frame. And when you get that kind of stretch, and I'll pull up the Russell just to show it, when you get this kind of stretch, this fast move down without any relief, right, that sort of a stretch is what gives you those huge potential bounces, right, where they just come in and they bounce and they look like they're going to the moon. And they're nothing more than a bounce potentially. That's the most positive thing this market has going for it, in my opinion, right now. So if we scoot over real quick on the fundamentals here, the Intel, right, the earnings themselves, Intel, JP Morgan, Wells Fargo. We had Wells Fargo and JP Morgan start increasing their bad debt reserves. Again, concerns about energy companies and defaults. Intel, shrinking in revs, they got just hammered, down 9%. And so these earnings so far not well received. You got a lot of earnings coming out this week. I've got them listed here. These are the ones that look the most important to me. And because they're big companies, they're in other industries, they're going to give us a glance of the broader effect of what's been happening and on earnings. And so these are the ones I'll be looking at this week to get a feel for if these earnings are going to be bought or not. As I said last week, we really should get a buy the news effect off of these because we've sold down so hard into earnings. If we can't lift this week on some of these earnings, I'm not sure what it's going to take to get this market to lift. And to wrap out the earnings, not so much the earnings, but the economics, you got a lot of data points in the holiday shortened week, just Tuesday through Friday, and you got Fed deliberations next week, right? You can't expect them to do anything else. I expect that they are probably going to start paying a little bit more attention to the market and try to help it by throwing some sort of a bone to it. But we did have a lot of speakers this week, and there was very little in the way of dovish talk out of the Fed members. So I'm not sure how much to expect. And I guess the reason I say that is because if they do throw a bone to the market's going to latch itself onto it. So we come over and think about it from a bottom line perspective. What do we think is going to happen? Well, the S&P, I showed you the chart here on the S&P on the daily where we don't have any sign yet, but if you go over the weekly, it actually tested. It tested Friday. Now the problem is it tested it with almost as much volume, 253 almost to 250 to 260. So you had almost as much volume, but you hit that August low, you come under it, back over it, you have less volume. That is a successful test in both senses of the word. In other words, you get into the price, you don't find more sellers there, right? You flip around. Now, I had already said that I expected that if we came down here to test this, it would be successful. And the reason for it was the extent of the move to get there. It's very hard to break something this major out with that much volume sitting on it. It's very hard to blow that thing out after you've already made this plunge. Right? You're probably going to get some sort of a bounce, some sort of at least congestion here before you break it and go lower, if in fact that's what's going to happen, right? So, this was kind of a no-brainer probably to say that, and Friday was probably a buy, and unfortunately I was on the road and wasn't able to post, but that would have been the buy in my book as it came into this price point. Given the setup, you may get that buy again on Tuesday especially with other markets trading. That may be the setup. It may not, because you may see, in other words, we may gap down there and test, but we may not see it. In other words, we may see those other markets turn by the time we finally open on Tuesday. And so if I had to make an educated guess, I would say that that probably was a short-term bottom. And that's despite not having any other evidence to back up that notion. And purely from a money management perspective, the return on the risk here is very high compared to the reward on the risk is very high compared to the risk itself. The probability of this area serving as a short-term bottom, it's not that high, unfortunately. In other words, we don't have the other signs. We don't have signs overseas. We don't have, we don't have much in the way of sectors which we looked at earlier. We just don't have any additional evidence. Now, that could form very quickly, but right now we just don't have it. I think that we have to keep in the back of our heads here, even when this market bounces, that the risk of a larger breakdown is out there now. It's not going to go away. And over the next few weeks, you're going to see that potential risk increase and the possibility of a big break, right, a top being made in these markets. Best, worst, and likely case, I think the best case is you bounce back to the bottom of that weekly retest regen zone. And so if I pull the S&P back up here, the retest regen is going to be off of this bar. It goes up to there. I think the best case is you get a bounce right back up into this area, and so a push right back into here, and it's always kind of amazing. But notice that bounce on Thursday took us right to that number, almost exactly. Right, the number there was 1954, and we got to 1950. And so you bounce right up into that area, and then they sell it off again. So I think the best case is you get back up there. What's the worst case? The worst case is probably a break of these August lows and potentially a break of the October lows. So if we go back to the charts here, if I'm looking at this, a break of this low, that would be a worst case kind of scenario. And if it breaks that, right, it's going to go after this next low. And that low is 1820, and we're sitting at 1880. So 60 more points to the downside if it does that. What do I think is probably most likely? I suspect we're going to test these again. It's a little bit harder this week because we're not trading with the rest of the world, so we're probably going to see some sort of a gap on Tuesday. And that gap is either going to be down there to test it, or it's just going to gap up. But if we do go down to test it again, I expect it's probably going to hold, and we'll get some sort of a lift out of it. Now, my concern is that lift doesn't take us anywhere. And we don't know that that's going to be the case yet. But the worst case scenario, right, is over the next 2 or 3 weeks, if price trades somewhere in this area and it never gets back up here. Right, that would be the worst case, and I'm going to draw this in here. That's the upper range, right? This is the lower range. In other words, we can't get back up here to even test this higher range or get into this higher range. That's kind of worst case. And the real bad case is you simply can't even lift above here, right? So in other words, price just hangs around in this area and then eventually breaks down. And I think that's the biggest concern whenever we finally do get some sort of a lift out of these markets. If you take a look at the portfolio down here, not much to say. Whittled it down to just a few positions, stopped out of a lot of stuff. Not hurt nearly as much as the markets, but certainly in losses. And anytime you're suffering losses, it's not good. The ideal trade here is on this S&P, and if I go back here to the daily, get this thing to come down and test again, be able to get into this with a fairly large position and catch a bounce, and put the reward in your back pocket and get out of the way again. That's the best trade setup that's out there. Probabilities are probably not that bad given the stretched nature of it, but you have to realize things can get worse. They don't have to get better. In other words, stretch can get more stretched, just as we saw this last week. Okay, that's the scenario. That's where we're at. It's going to be a tough week again, but I expect we're probably going to claw out some sort of a bottom here and get a bounce. And then it's going to be about, what does that bounce look like? Thanks as always. Take care. Bye.